Good morning, Victor Bales coming to you from Highlands Mortgage here in Brighton, Michigan on this Sunday morning, the 29th. I am self-quarantining, if that's a word, and I'm here at the office with nobody else here, and I'm just looking at these government interest rates for FHA, rural development, and VA loans, and it's a mess out there. March 9th, rates dropped to almost an all-time low, 3.25% on a 30-year fixed across conventional and government loans. But now conventional loans are still respectable, but government loans has went through the roof. And I'm going to give you an example here, and I want to explain why. But I'm looking at pricing right now on a 640 credit score, FHA, 3.5% down, and I'm pulling interest rates and I'm seeing 3.875%, not a bad rate, but in order to get that rate, the client has to come with two discount points. This is a $200,000 loan. One discount point equals 1% of the loan amount, or $2,000. It would cost them $4,000 extra just to get the 3.875%. So why is that? Well, I want you to imagine you are a servicer. And when we, the lenders, originate loans, you guys, the servicers, pay us 1% or about $2,000 to take the servicing rights for that loan. Okay. And you'll get paid about 30 bips or about $600 a year to service that loan. So that means you, the servicer, have to have the servicing rights or collect payments for about 3 years to make up what you paid us, the lenders, for the servicing rights. Okay. So now, with that said, last week we had about 3.2 million jobs lost. Okay. And predictions are that this unemployment rate could go to 10, 20, maybe even 30% before this coronavirus thing gets a handle on it and the country's open and we start to recover. So the servicers of the government loans, and government loans are typically lower credit scores, higher debt to income ratios, that means affordability here, and also they have less reserves. The average government loan has the client will have about 3 months of reserves to make their payments once they close the loan. So now, as we look at this unemployment rate or the potential of it, these servicers are getting scared and they're backing down. So let's say we sell the servicer 10 loans, okay, and you are the servicer. Now pretend those loans were pills on a table. And with a 10% unemployment rate, chances are one of those loans, or 10% of them, are going to default on their payment. Now, remember, you're the servicer. You still are obligated to make that payment to Ginnie Mae, who holds the actual security, the bond security for that mortgage. So if the borrower does not make the payment, you are still obligated to make that payment. And if you have to make that payment, you are now eating up your cash flow. Okay, so it's going to start biting into your cash flow. So when we, the lenders, sell that servicer 10 loans, you're going to say, as a servicer, wow, I've got 10 loans coming in here. And let's pretend there's 10 pills on the table. And we know that one of those pills is laced with cyanide. And if you, the servicer, knew that, would you take any of those pills knowing that one of them is laced with cyanide? Okay. So I just want you to think in that in a common sense situation here. So what's happening as the market continues to be volatile, we're seeing these servicers wanting to back out of doing mortgages. And so as I'm looking here at the rate sheet and some of these servicers here, for example, I can get Lakeview Loan Servicing. They're going to charge that client to get 3.875%. They're going to charge them 2.75 discount points, about $5,500. But I look at another servicer at 3.875, Home Point Financial. Man, they want 6.125% points, or about $12,000 to honor that rate. And why is that? Well, let's look at you as the servicer. Because remember, it's going to take about 3 years for you, the servicer, to make up the servicing that you paid for the loan. So you could be profitable. But at these rates, they're going to charge you these high discount points to attain that rate because we know as the economy starts to recover, rates are going to start to drop again. Now, if the loans that you just bought for servicing rates start dropping, what are these customers going to do? They're going to start refinancing. And if they refinance within the 3 years it takes you, the servicer, to make up that money, you're going to take a loss. So that's why you are charging the premiums of 2.5 points to almost 7 points here on the premise that that loan is going to default or going to refinance. So it's crazy out there. And this isn't just us as a lender, this is universal across the board, all lenders everywhere. So now, as we look, what's going to happen? They're going to try to position, and my advice is what you're going to do, and I've got buyers in the pipeline right now, not locked on an interest rate, in these government predicaments. So I'm watching rates hourly, daily. I'm here on the weekend, just kind of looking to see where the market ended up because we're trying to get a respectable rate with no discount points here. But some of my clients do not have the reserves to buy down that interest rate. So what's going to happen is I see these servicers, they love the service to conventional loans, is I can see some guidelines are going to start changing here. And I think what they're going to do is raise credit score guidelines to match conventional. So whereas before we were doing 620 on FHA, 600 or 640 on rural developments, I can see they're going to start raising these credit scores to maybe 640, 660, maybe even 680 to make the loan more sellable or make it more secure. And also with the government loans, especially FHA, we used to be able to go up to 55% of the person's income to qualify them for a mortgage. So that's the affordability. I think lenders and the guidelines across the board are going to start changing. They're going to lower those debt to income ratios under 50, probably maybe even between 40 and 45%, which allows the buyers to afford less. I think they're also going to make the reserves, the amount of money the person has in the bank at closing, they're probably going to raise those reserve requirements where they were much lower before. And will this be next week? Will it be the week after? I think what's going to happen here is we're going to start seeing some changes. I don't think they'll go crazy overnight, but we're going to start seeing these changes incorporated maybe next week. And then the next week, they change them a little bit. The following week, they change them a little more here so they don't shock the world here or the lending community or the origination community. So I can see that coming. Until April 15th when Trump opens up the country here. Hopefully that'll start getting back to work. But for now, what advice do I have for clients? Well, if you're in a purchase environment right now and you're waiting to close and you're not locked, well, you just got to ride this out here and we will do the best we can. But my advice for anybody else out there searching to buy a home and you're in a government product such as FHA, VA, or rural development, you may want to work with your lender and say, hey, what do I got to do to raise my scores? Because I guarantee you, you're going to be paying discount points if you want to close on that home. Maybe you take that money, work with your lender, improve your credit scores, improve your position, and maybe you just hold out buying for now. But I absolutely advise work with your lender. Get in a better credit score position because credit score is going to be very important as we go forward. So, with that, I hope you understand the servicing aspect of it, and that's what's driving up interest rates here. If you got any questions, give me a call or log on to victorbales.com or just leave comments below, like or share. But that's what we see going on here, and it's going to be a little volatile probably for the next, I'd say, 2 to 3 months here. So, thank you very much for listening. Talk to you soon.